Well, good evening, traders. Thanks for joining me on this Thursday afternoon. Today's date is the 20th of March 2014. What I'd like to do for you is really talk about sort of the long-term implications of American Express, really talk about the primary trend, also the intermediate trend, and the possibility for some incredible lower lows which are going to be made on AXP throughout 2014. There's a lot of cautionary signals being generated on AXP, and it is quite fascinating to address the possibility of quite a substantial bearish move in the face of what appears to be a very healthy and strong bullish trend. So what I'll do to begin with, this is just simply a daily chart if you look at my screen up here of AXP. And the first thing I want to address is really this green rectangular box down here. Now the green rectangular box, it's not anything complicated or anything difficult by any stretch of the imagination. It's simply a target or an area of support which is very, very likely to be hit in the event that AXP reverses and starts making a series of lower highs and lower lows. The reason is because throughout the year of 2013, you can see in this red sort of highlighted circle, which I've just circled, is the fact that we bounced into the support level at least 3 times over the space of about 5 months. And if you put this into sort of a different perspective, it's simply the fact that we were consolidating for 6 months. Now, what that means is that there was a short-term agreement on price between buyers and sellers in this area. So between the area of $78 and also down the bottom, roughly $71, there was a short-term agreement on price which set up a very nice channel consolidation pattern. Now since then we've broken out and we've started to trend. According to Dow theory, we've been making a series of higher highs and also higher lows, which is textbook Dow theory trend analysis. But this is where the picture starts to get convoluted and a little bit messy. Really, since January 2014, you can really start to see this trend beginning to break down on AXP. What I mean by that is right here, we've had an amazing gap at an all-time high. Instead of continuing in the open window, when we get a gap, we trade in the direction of the open window. This gap has actually failed. It hasn't only failed down to the bottom of the range of the window, it's actually sold off quite a fair bit. And again, is sort of, I guess, reminiscent of January's trading behavior as all 3 US indices sold off. But really since then, this is where the kicker comes in. If I switch to the oscillating indicators, what I want to bring your attention to is this MACD indicator and this sort of, technical indicator which we call bearish divergence. So for bearish divergence to establish itself, you need to be making a series of higher highs on price. So as you can see, we've got 3 circles, we now have 4 circles, and as of March 2014, we have 5 circles here. So we are making a series of higher highs on price. However, when you mix that and cross that over to the MACD, you can see these 3 signal line crosses, which are actually sloping at a negative sort of gradient. Now, this is telling us that price and the momentum of the share are actually diverging away from one another. It's telling us that the momentum is actually starting to slow down, which is a very, very strong, if not the strongest, early reversal signal which we have for a terminal trend reversal. What I mean by terminal trend reversal is the fact that we could completely reverse and set up a new bearish trend leading into 2014. Pardon me, just got a sore throat there. Let me just have a drink of water. Pardon me. Much better. So what we've done here on AXP anyway is really addressing that divergence which is taking up on the actual price. You can see I've just got this orange sort of trend line. All this does anyway is just alert me that, hey, you're trading in the face of bearish divergence if you want to place bullish trades. Now what we can see anyway moving down into the detail is the fact that we made a higher high literally by a few pennies, but since then we've had really a few variations of quite bearish candlesticks. We've got bearish engulfing patterns, we've got hangman patterns at resistance, and what appears to be setting up for a bear flag. Now this is a continuation to the downside, so what we have is an initial trigger down here at $88.52. So that's the initial entry on AXP to get into long-term bearish positions, trading down to $72 a share, or at least $71 a share. Now this isn't going to happen overnight. This is more sort of, I guess, a multi-month trade which we will be holding in the event that we do move and close below 88.52. But it's definitely, I guess, a good warning signal to people out there who may be watching this video who hold AXP long-term to really consider where you are on that position. If you are profitable on it, it would be hard not to be profitable. And then to at least sort of inquire about taking taking out some insurance policies in the way of options contracts to hedge yourself against downside risk, which you may be holding in the event that you obviously have or you have ownership of the underlying stocks. So there's a few various strategies and techniques that you can put in place to sort of counteract the potential downside movement. Or straight out, if you're not holding AXP long, then there are definitely some fantastic strategies in the way of buying puts that are going to set you up to make a lot of money in the event that AXP decides to oscillate down to roughly $70. Now again, that's a target, that's a macro target, but ultimately what bearish divergence does is that it reverses a long-term trend. And really the next sort of macro support area that we're looking at is all the way down here at $55 a share. So if you're holding AXP now, and you're seeing the price at $90.73 and saying to yourself, well, there's a possibility that we could be heading back down to $55 a share. Wouldn't you want to take out some sort of insurance policy against that position to hedge yourself against risk? I mean, these are the type of questions you need to be asking yourself if you're transacting in the market, even as a passive investor and someone who just simply buys and holds. You can see here, for the most part since November 2012, you've caught an exceptional part of the trend, and you can see those periods of consolidation which set up before we get the next move higher. But right now we've got all of the terminal reversal signals that we need as technical traders to really start looking at this from a different perspective and sort of setting ourselves up for the terminal reversal which could take place in AXP. So thanks a lot for watching this video anyway. If you want to learn how to read the markets technically and how to trade the market short term, have a look at Pivot Point Trading and sign up for a scholarship anyway. Free education, 12 hours and a complete sort of foundational base to get you started in trading the stock market as a scholarship initiative. So it is a great resource and a good way to get started. If you do have a little bit of interest in the market, I'd highly recommend checking it out and learning some of this information for yourself. So if you have any questions, post them down below. Other than that, have a great day. Goodbye.